So the same way you have MIRR trying to solve the weaknesses, the problems we had with traditional IRR, this duration has come to also help some methods, and that is talking about the discounted payback method. Yeah, both the payback period and discounted payback period. Remember, both this method, the payback period and discounted payback period, they have one thing in common, and that weakness is the fact that they don't take into consideration the full cash flow. So this does not consider the entire cash flow from investment. Remember, what we used to do is to just calculate the payback period and we compare with our company policy or our target or our benchmark to take investment decisions. So sometimes some investments are good at the beginning of their lives, but they are horrible at the latter part. So you could have selected a good investment because yes, it's breaking even quick. However, by the time you finish that investment, the total cash outflow might even be more than what you are getting as inflow. And that means you would have made a wrong investment decision, or you would have rejected some investment because they are not breaking even early. But maybe the later part of that investment will really be very, very liquid and profitable, but you would have rejected such investment. And that is what duration has come to solve. That problem, that weakness of not considering all the future cash flows. That is what duration is trying to fix. Right. So what is duration? Duration, as it sounds, is a measure of time. So the way I will put it is a weighted average. Let me put it like that so that you can start relating to it. It's a weighted average of time. So you're going to have a weighted average of time to recover the total present value. Remember, I didn't say net present value of a project. Cash inflows. So you are asking yourself, all these cash inflows that are coming from this project, what is the weighted average time that is taking us to get all this money? Likewise, you can also interpret it to calculate the weighted average time it's going to take us to recover the initial outlay. Remember, in your previous payback period, we are always focusing on initial outlay, right? However, we focus on, for payback period, we focus on the raw cash, but for discounted payback, we focus on the present value. So for this duration, we will always focus on present value. Please take notes. Always on present value. That's what we're going to be working with. So I'm going to explain to you if you have to do it to recover all the cash inflows or you have to calculate the time to recover the cash outflow. That is the possibility you can have. Those two possibilities are quite examinable. Yeah. So we're going to do that quickly, and I'm going to use the same example that we had before. Yeah, so talking about our 8,000, this simple example, let's use this one. Yes, this same example is what I'm going to use. So we already know the PV. So I think we use it somewhere where, yes, yeah, we have the PVs here. So I want to use this one to calculate the duration. So which we need to be asking ourselves, what is the weighted average time to recover this present value? Remember, these are the present value of all the cash inflows. And the total is 22,3939. But one thing you need to understand is the fact that it did not take you 4 years. Remember, we know this is year 1, this is year 2, this is year 3, and this is year 4. We are very, very sure that it did not take us 4 years to recover 7407. it only took us 1 year, but it took us 2 years to recover 10,287. It took us 3 years for this, and it took us 4 years to recover 1470. So we cannot say it took us 4 years to get this figure that we're talking about, this 22339. So we need to weight each of this number with the amount of time it took us to get them. And that's exactly what we want to do. So the total is 22339 for sure. So we need to get that proportion. So all of them will be 22339. There are 4 cash flows. So for the first one, year 1, year 2, year 3, and year 4. All of them divided by 22339, because we need to find the weighted average. It took us, so let's go back to our PV. So we're saying that 7407 out of 22339 took just 1 year. So 7407, put it there. 7407 took us 1 year. So we need to calculate what that time is. Hope that is clear. So we'll go again. The second cash flow. So we can see that the 10287 took us 2 years. So 10287 out of 22339 took us 2 years. Likewise, the third one is 3175 out of 22339 took us 3 years. And the last one, which is 1470 out of this 22339, took us 4 solid years. 4 solid years to recover. So which means we now need to calculate the weighted average time using our calculator quickly. So that's 7407 divided by 22339. So that means that is 0.33. Then 10287 divided by 22339 times 2, that's 0.92. 3175 divided by 22339 times 3, 0.43, and 1470 divided by 22339 times 4, and that is 0.26. So this is the total time that we need to add together to see how long it took us. 0.43 plus 0.92 plus 0.33. So it took us 1.94 years. That is the average time that it took us to recover all those cash inflows. And that is the duration. It's measured in years. So it took us solid 1.94 years. And you can see it did not take us 4 years, because like I explained to you, only 1470 took us 4 years out of all the cash flows. All the other ones were shorter, and that's why we need to weight it with time. And that's why we're multiplying by the number of years each proportion took us. So this is just same proportion multiplied by the number of years that it took. That's the way to look at it. Similar to the approach we use for WACC, when we use just to calculate the volume of debt, volume of equity divided by the total capital, then multiply by the cost of each capital. So that is it for duration. So that is duration formula, and that's how you have to calculate it, especially when they say calculate the duration for the cash inflows. But you can also be asked to calculate duration for initial outlay, like how long will it take to recover the initial outlay. Please take note that the only difference with this one is the fact that your discounting factor must be done. So your discounting factor must be calculated using a discounting rate that is equals to IRR. So you must know your IRR before you can calculate the duration for initial outlay. Very important, because if you don't do that, you will not have the answer. So let's work that out for the same example, which means we need to know what our IRR is. If you remember on the Excel, we actually calculated our IRR. I think on Excel we had 14%. So let's say we assume that IRR is 14%. It means that the discount factor that we're going to be getting, that we have to use, must be at 14%. And I hope that is clear, because you need to avoid those confusion. It's not meant to be difficult, but if you don't pay attention, it can appear difficult. Okay, so this discount factor that we used initially, this one was the cost of capital, 8%. You can only use that if you are calculating the duration for the inflows. But if you want to calculate the duration for the outflow, you have to use your IRR as this kind of factor. So which means we will need our factor, discount factor, at 14% for all the cash flows. Let's do the cash flow. So we have year 0, 20,000, year 1, year 2, year 3, and year 4. And for each of those years, we have 8,000 here, 12,000, 4,000, and 2,000. And discount factor at 14%, we have 0. For year 0 is going to be 1. For year 1, 0.877. Year 2, 0.769. 0.675. And 0.592. Then we're going to get the PVs. Definitely this remains 20,000. We have business with that. Then we calculate 8,000 times 0.877. That's 7016. 7016. 12,000 multiplied by 0.769. That's 9228. 4,000 times 0.675. 2700. 0.592 multiplied by 2,000. 1184. Yeah. One test you should know is that because you are discounting at IRR, remember NPV has to be 0. So for NPV to be 0, it means that the addition of all of this, if what you are doing is correct, must give 20,000. So let's test it. Let's add this together. So 1184 plus 2700 plus 9228 plus 7016. And that gives 2128. That 2128 is because of approximation of these factors. So please just make sure you use exactly initial outlay. So you use 20,000. That would be your total, because it has to be 0. Right. So the same approach that we used, that's the same approach we're going to use again here, which is saying that it took us 1 year to make 7016, 2 years to get this one, 3 years to get this one, and 4 years to get this one. But we need to weight it over the initial outlay of 20,000, which is the total of all of them. So, which means, first of all, 7016 out of 20,000 took us 1 year. 9228 out of 20,000 took us 2 years. Only 2700 out of 20,000 took us 3 years. And 1184 out of 20,000 is the only one that took us 4 years. So we need to get all this timing to know what our duration for the outlay would be. So 7016 divided by 20,000, that's 0.35. 9228 divided by 20,000 times 2, that's 0.92. 2700 divided by 20,000 times 3, that's 0.41. 1184 divided by 20,000 times 4, that's 0.24. So we need to add all of that together, plus 0.41 plus 0.92 plus 0.35, and that gives 1.92 years. So took 1.92 years to recover the initial outlay, but 1.94 years to recover all the cash flows. As you can see, this is for the initial outlay, and this is for the inflows, PV of inflows. So that is it for duration for both the inflows and the outflow. And let me also quickly mention this to you, that the duration that is called Macaulay duration, probably have heard about it, Macaulay duration. Is the same thing as the duration that you have done. Please take note. It's just your normal duration. Don't get confused if you see either duration or Macaulay duration. It's the same thing they are talking about. Exactly the same thing. Please take note. Okay? But how do you take decision? Just like payback period, the shorter the better. Because you want your duration to be short. So which means if you have a target, you want your duration to be less than your target. If your duration is longer than your target or your policy or your benchmark, then you have to reject that investment. But there's a final concept on duration I'm going to touch on, which you need to know is called modified duration. I know this might sound like an improvement over duration. No, the fact that it's called modified duration doesn't mean that it is an improvement on the Macaulay duration. This is just a different way of measuring different things. While the duration is measuring time, modified duration is not a time measure. Please take notes. Let me put it down. Not a time measure. Rather, what this does is to measure sensitivity. So this guy measures sensitivity. Please take note. That is what it's used for. And how is it used? The type of sensitivity it measures is the sensitivity of price to yield. So it practically measures price sensitivity of bonds to the interest rate or yield. And that's why in terms of formula, it's just calculated as percentage change in price divided by the unit change in yield. Yeah. And most importantly, the reason why I'm even mentioning this is because there's a formula that links both Macaulay duration and modified duration. So if you are asked to calculate modified duration and you are given Macaulay duration, the formula is to just say modified duration is equals to Macaulay duration divided by 1 plus cost of capital. This is actually the important formula that I want to mention to you. So it's very important you know that there's a relationship between both of them. So with that example that we did earlier on, when we did the Macaulay duration, we got 1.9 for the outflow. We got Macaulay duration of 1.94. Yeah. So which means if we need to calculate the modified duration will be 1.94 divided by 1 plus, I think the cost of capital was 8%. Let me be sure. Yes, the PV that we used was 8% cost of capital. I think I remember. Yes, this one. That's how we got our PVs. So which means that modified duration will be 1.94 divided by 1.08. So 1.94 divided by 1.08. And that will give us 1.8. So which means our modified duration is actually 1.8, but our duration is 1.94. Please take note, very important, and that's where I'm going to end that part. We'll continue with the investment appraiser. Is a big chunk in this syllabus, so but it's good at least you've had a very good start as to how you can do investment appraiser. Remember those other methods that you have to revise. And another concept quickly that I'm going to tell you to revise is capital rationing, because I know I've also dealt with that in detail and it's important for this syllabus, but it's also just the same thing as you learned in FM. Please refer to my lecture 29 in FM for capital rationing. Both soft or hard rationing is there. But also good to mention to you that the capital rationing that we did in FM is just for a single period rationing. That is what we did in FM. Single period. That all those calculations, whether it's if you remember divisible or not divisible, is a single period rationing. I hope you remember what this means, because remember we'll just do year 0, you need 20,000, then we'll do year 1, 10K, then inflows will start coming, yeah, in other years, because the only outflow is just beginning of the investment, and that's why it is called single period rationing. Whereas that is not always the case in the real sense, because in the real sense you can actually have investment that you are starting with 20,000, then it starts giving you money truly 10,000. Year 2 it gives you another 20,000, but you need to spend money in year 3, maybe for maintenance or for expansion or for something. Then you have another 15,000 to spend. Then now this is becoming multi-period rationing, and that is another dimension you can see in AFM. But the good thing and the good news for you is that you will never be asked to do a calculation on capital rationing for multi-period. If you are going to be asked to do a calculation, it's going to be exactly like you have learned in FM, which is a single period. Yeah. But you can be asked to discuss this one. So there might be a theoretical question on this one. Yeah. And all you need to know is that if you need to solve this kind of problem of multi-period capital rationing, there's a way to go around it, and that is by using linear programming. And that's why you will not be asked to do it in exam, but you need to be able to discuss the meaning and the solution. That is where I'm going to leave it. For Monte Carlo simulation, we'll do it as we move on into the syllabus. And please remember to keep practicing questions. Ask questions if you're not clear of anything. Keep liking and keep sharing. Bye now.